We got to talking about our work down there, and then they were like, it's time to go on stage. So, anyway, thank you all for being here this afternoon and lending your time and ears to being a part of this conversation. My name is Will Butler. I'm the Senior Director of Global Portfolio at Unreasonable Group, based out of Boulder, Colorado, with offices a little bit everywhere. And I must say, I'm incredibly honored to be asked to facilitate this conversation. I was that kid in uni who sat in the front row and just raised his hand the whole time asking questions. So to be able to get to do that here is a real joy and a real privilege. I guess as a little bit of background on my own work at Unreasonable Group, we support a community of over 350, I believe at this point, growth stage entrepreneurs, each of which are addressing social or environmental impact at scale. We work with multinational institutions to discover profit in supporting businesses like these. And we also operate as a bridge between our entrepreneurs and our investment community around the world. So we support our companies in their capital raising efforts. As I was just mentioning to Laurie, who's about to come on stage in a minute, we recently launched a product, I guess about a year and a half ago, called Unreasonable Collective, that also gives accredited investors the ability to pull capital and invest directly in the types of businesses that we support and work with at Unreasonable. So yeah, that's a little bit about me. This conversation about rethinking sustainable investment is something we talk about and think about all the time at Unreasonable. So it's really, like I say, it's a gift to be able to do this. We're going to cover a few different topics over the next hour and 15 minutes, which I'm confident will fly by. So it'll range from actually how do you quantify, how do you measure impact? What are the gaps in the investment ecosystem at the moment? How are banks thinking about it? How are individual investors thinking about it? How are corporations thinking about it? I also have the honor of then inviting Kevin Tawali up to the stage, who is the co-founder of ChangeNow, and thinking how ecosystem players like this are bringing people together to support this community, to push sustainable investment forward. And once again, thank you all for joining and being a part of this conversation too. I guess it would probably be helpful for the panelists coming up if they had a feel for the room too. So if you wouldn't mind a show of hands, I'm just going to ask a few questions, and maybe some fit for you, maybe some don't. But I'd like to know just, are there members of the investment community or finance professionals in this room? All right, cool, friendly audience. Maybe folks from entrepreneur or work and ventures or kind of in that startup ecosystem. Anyone out there? Great. Maybe ecosystem players, whether that's an accelerator program, university program. There we go, guys. Some of my colleagues out here as well. And how about any folks from academia? Any folks from the university system? All right, cool. We may not get too wonky then if there's only two of you, but we'll see where the conversation goes. Well, with that, I guess I'm going to sit down and I will welcome this panel up to the stage. And Laurie, I'm going to start with you, or maybe just all come up at once. We don't have to. Sounds good. Well, I guess before we get going here, it'd be probably wonderful to introduce ourselves. Olivier, I'm going to start with you. Just a little bit about yourself, your work, and also why you're excited about this conversation.
Thank you. Thanks for having me here. I mean, it's a very big and very high energy event, so it's great to be here and speak about sustainable finance. I'm Olivier Vinciguerra. I'm the co-founder and chair of GreenRWA. So I'm going to try to explain in very simple words what we are doing. GreenRWA is an association rooted in the belief that banks have a key role to play in the financing of the energy transition. So we're trying to support and sometimes push banks to be more involved, and I think we can see in the last 2 years that this has changed a lot if you look at the net zero plans and the commitments of a lot of banks. And the way we are doing that is really through risk management. So we see banks as risk engines, and we are developing new modelization to help understand what are the climate risks that are embedded in the portfolio of banks, physical risk, transition risk. And we're publicizing these models and hopefully, get the community of banks and central banks to use them, understand better their risk, and in the end, change their portfolio and finance more of the investment we need, the massive investment we need over the next years. Hope it's clear.
Amazing. Thanks for being here. Laurie, over to you.
Great, thanks, Will. It's it's a delight to be here. My name is Laurie Spengler, founder and CEO of Courageous Capital Advisors, and we are a specialist impact advisory firm. Really think of us as an impact investment bank. We structure investment products primarily in the private asset classes and bring them to market, raising capital on behalf of entrepreneurs as well as asset managers who are deploying the capital to generate the impact. I also spent a lot of time in field building. I know we're going to talk about that, Will, because I think if you're a practitioner in this area, you also really are obliged, I would argue, to spend time building the field. So I serve on the Global Steering Group of Impact Investing and served on the G7 Impact Task Force at the end of last year. And my motivation for this conversation is that for me, money is a means to an end, and the end is in service of people and the planet. And for me, especially today in this conversation, I'm delighted that climate has attracted so much attention, but unless we embed people, principles of inclusivity, principles of fairness, principles of equity, where that money is flowing, we won't have long-term sustainability. So my motivation in coming to these conversations is really how do we integrate climate and people, climate and inclusivity. It's not either or, it's the combination. Thanks.
Amazing, thank you. Emmanuel, over to you.
Thank you, Will. Hello, everyone. I'm Emmanuel Parmentier, managing partner at INDEFI. So INDEFI is a strategic consultant working for the asset management industry. We work both for asset managers and asset owners. And we are a team of 85 people in Paris, New York, and within this relatively small firm, 85 people, I'm managing a team of 25 people working only on sustainable finance. So we help asset managers, asset owners to progress in their sustainable journey. And so my motivation here today is to discuss, asset classes or type of investors that are below the radar, usually, not the big names, so private assets, private equity, LBO, venture capital, private debt, also family offices that are joining this conversation and are leading also in some aspect the sustainability journey.
Amazing, thank you, Emmanuel. I guess the general prompt is how might we, advance sustainable investment. But I'll start with you, Emmanuel. I mean, how are you thinking about sustainable investing, and how do you measure that impact?
Yeah, well, first, word count. So why sustainable investment and not ESG or impact? How we interpret this move from ESG to sustainable investment is, I think it's interesting to understand that. So a few years ago, the world was relatively simple. You had ESG investors focusing on ESG risks, so environmental, social, governance risk in the operations of the companies. So they kind of exclude some companies, integrate ESG criteria within investment decisions, and then engage to influence the CEOs of these companies. And then you had also impact investors, different bunch of people, smaller in general, and focusing on the impact of products and services of the company they invest in. And what we call now sustainable investment is a mix of both. So you both analyze the operations of the companies and the impact of their product and services. And why is it really important? Is because now it's a matter of value creation. So if you're discussing the impact of product and services, the green share of the business, that's where you create value. And the nicer example of that is the brown to green strategy. So you buy a company, you transform it into a green company, and you sell it to a bigger impact fund. And these people have money now. They have raised really big impact funds, and they can pay you a lot of money to invest in these companies. So yeah, measurement is key, but transformation is more important. Yeah.
Amazing. Thank you for sharing. Olivier, I'm going to bring it over to you to actually follow up on that. I'd love to hear how you're thinking about it, too, with Green RNA and your team there.
So I think, in Europe specifically, there is quite a simple way, or at least one way, to look at what sustainable finance is about. And I will take the angle of the EU taxonomy. So basically, I mean, I don't know how much you know about it, but basically the EU taxonomy, which is imposed now both corporates and financial institutions, is a green dictionary. So it's about defining what is green, what is non-green. And corporates, for example, have to evaluate how much of their revenue is aligned with the EU taxonomy principles under different sectors, which are very impactful from a CO2 emission perspective, like, of course, manufacturing, transportation, agriculture, etc. And it's a very important tool because it gives a definition of what is green. So by definition, a bank which is supporting or financing a company which has a good taxonomy alignment is doing sustainable finance and will help, in a way, give visibility about where we are today, and hopefully, as banks or corporates commit to a higher alignment with the taxonomy, we will see the transformation of the economy, of the banks, and ultimately have a greener economy and minimize the temperature increase that we all are working here about. And I think so the taxonomy from this perspective is very interesting. Of course, it's Europe only, but there are other taxonomies building around the world, sometimes from private group of banks, sometimes from other countries like in China, although I would say that the EU taxonomy is much more advanced. But we see that, you know, we're going to have a common definition on what it is and to impose that definition to everybody so that everybody is at par and is playing on the same level and they avoid kind of arbitrages on the market. So that's very important. I think what's good also with the taxonomy is that it's now, I mean, it's been decided and it will be enforced that it's going to cover all sectors to define which are green, which are not green. So we'll have a clear visibility on the whole activity of an economy. And what's also very important is that it takes into account other criteria, like not harming the environment, but also what they call the minimum social safeguards criteria, which are qualitative for now, but are very important and are necessary to claim the alignment of the taxonomy. And I guess that's a topic, Laurie, you know much more about than me, so I will let you discuss that.
Amazing. Yeah, please follow up.
So I think I loved your use of green dictionary instead of taxonomy. Taxonomy is not a user-friendly word, so we should call them all dictionaries, not taxonomies. I think what both Olivier and Emmanuel have pointed to, we have a lot of tools out there now that allow us to scrutinize what's happening with our capital. But you do have to ask the questions. We tend to take the view of ESG, ESG+, and impact, and we are definitely driving towards impact, but obviously meeting people where they are and where they're starting. And I think the criticality is the delineation, not with an attitude of judgment necessarily, even though we would like to see more capital flow to contributing to the solutions that meet the needs of people and planet, which is really where impact sits, but understanding what the capital is doing and most importantly, what it's not doing. And I think we were talking before we came on stage today, some of the criticisms about ESG. We've had all kinds of criticisms about it because there isn't a rigor, there isn't a spotlighting, there isn't accountability, and people are using it a little bit like, I dare say, the SDGs, tagging. This is not about tagging. This is about really looking at the flow of capital and what is happening, what is the change in that community for people based on the delivery of a product or service. And I think the good news as our community and practitioners, we have the tools now. We just have to use them with more rigor, more discipline, and shine a spotlight on the good examples as well as the not so good examples.
Amazing. Laurie, I have a follow-up question in there. You spoke about the need for higher flow of capital. How do we get more traditional funds or family offices involved in this space and focused on sustainability-minded investments?
Yeah, I mean, there's no question we need more capital. The SDG update report from the UN now says that we need $5 to $7 trillion a year, not the $3 trillion that's been cited previously. And part of that, of course, is the pandemic influence as well as our lack of progress across all of the SDGs. We've made relatively more progress on climate than the social objectives, but across the board, we're far behind, which speaks to the need, Will. And I think you're absolutely right. Institutional private capital has to play. We've got to find ways to encourage, invite, support that capital flowing. I think the family offices and foundations that have often been the pioneers and the leaders have demonstrated what the viability is of some of the strategies. I mentioned that in my introduction, the G7 Impact Task Force. I never recommend a report, except that in that report, we really did tackle this question. How do we move institutional investors from where they are now? And I think it is fair to say that risk mitigation instruments, guarantees, insurance products, we have underutilized those in structuring investment products. We know how to do it. We don't need new tools necessarily. We have to weave them together. We hear a lot about blended finance, but some of the most successful examples at scale are funds, aggregated investment vehicles that do have a guarantee or an insurance element. And I would just underscore that's particularly important for emerging markets. And I know we're sitting in Europe today, and a lot of the great entrepreneurs here are based in Europe. But if we look at the disparities in flows of capital, emerging markets, it's shocking. And the trends are going in the wrong direction. And investors, oftentimes, it's the perception of risk that's holding them back. It's a faraway place. I haven't been there. It's unfamiliar. How do I don't have people on the ground. And that's why the risk mitigation tools, I think, are so critical. So to me, ultimately, we need both the family offices and foundations who are continue to be pioneering, as well as institutional capital. But I do think guarantees, insurance products, other risk mitigation mechanisms can accelerate that flow, particularly to emerging markets where we need it most.
Amazing, thank you. Emmanuel, I feel like you had something you wanted to add to that as well.
Yeah, maybe on family offices, because I know that in the US or Anglo-Saxon world, family offices and foundation were at the forefront of impact. But I would say that maybe in continental Europe it was a bit different, but it's changing really fast. And I was very surprised in the past couple of years to get incoming calls from family offices, very traditional families, I would say, because of a generation change that reconsider their view on ESG and sustainability. And what is great working with family offices is that it's a perfect match with sustainability. Why is that? Because they have a long-term view, because they invest in private assets, which are very close to impact and sustainability, because they don't bother with reporting or with satisfying a client, because they don't have clients. They manage their own money. So they have the time, they have the patience, and they really want to make it happen and create value through sustainability. And that's, I think, a novelty, at least in continental Europe. And maybe things are changing faster than we think.
Thank you. Olivier, I know you do quite a bit of work, too, in working with banks and helping identify opportunities. I'd love to see or hear from you as well. How do we better increase this flow of capital into sustainable-minded investments?
From that perspective, I think our approach in Greener W is really to say that mechanically, the kind of approach we have about risk engine should change the way banks are financing the economy. So the tricky part here is that, of course, we talk a lot about the tragedy of Horizon. So the very big difficulty of the climate change challenge is about embedding on the short-term, long-term effects. I think you need to be able to calculate on a very long term, like 30 years, because that's where we're trying to head on net zero 2050, all the effects of a portfolio or an investment, so that you put it right today rather than a very short-term horizon of current policies or current regulation. We're looking at a year time for the Basel Committee, for example, of the economic impact of the capital. So you really need to work on this very long-term and reconcile long-term with short-term, which is sometimes, the necessity for investors or for financial institutions.
Please. Can I just add two quick points? I really appreciate your next gen point. I think you're absolutely right. We're seeing those changes, which are fantastic. I think the long term, you talked about the temporal horizon, and you did as well. I think it's critically important. I was earlier this week speaking to an institutional investor in Scandinavia, and I was shocked when she said our time horizon is 40 years, 40. Now, not all investors can have a 40-year horizon, but imagine what you can do with that capital when you do have that kind of long-term perspective. So a little bit longer than the 2, 3, 4-year horizons, I think, is absolutely a need and an invitation. And the other thing I would say about banks, we all have bank accounts. Many of us are investors in banks as well. I do think the push from the public, from consumers, from depositors, can also nudge banks, because we can't just rely on investment capital. Banks are critical to the transition that we need in society, but I think we do need to be a little bit more proactive. There's a group of banks called the Global Alliance for Banking on Values, and that's what they have actually put forward. As regulated financial institutions, their mission is embedded in their business, which is to be part of the solution, not the problem of financing the old economy.
Amazing, thank you. Laurie, I guess one other question in there as well. I'd love to hear your thoughts on what are some of the gaps in the funding ecosystem at the moment. And as part of that too, I mean, in any sort of major transition, there's winners and losers. You know, how do we ensure just transitions as we move into this new world that we're all pushing for?
Thank you for that question, Will. I mean, I think the gaps, honestly, sadly, are everywhere. If we take the SDGs as our framework, I mentioned that we are so far behind on all of them, and then relatively speaking, we're further behind on the social strategies. But where I'm taking some positivity is where we're, again, beginning to combine our objectives. So if we look at adaptation for farmers, previously, if we were looking at ag, we weren't having the conversation about adaptation. It was just a sequestration or a reduction, a CO2 emissions reduction. And I think if we can be combining those types of opportunities, we can see greater progress. So, I mean, I do use the SDGs a lot, not as a way to tag, but to look at where those gaps are. So sectorally, I think it's on the social objectives, education, healthcare, agriculture, were huge gaps. And then if you combine that with the geography, the emerging market point. And I do want to say gender, because it came up in the earlier panel that we were listening to, and I think it's just it is still shocking in this day and age, the paucity of capital that flows to female-led businesses, female-led fund managers. And they're constantly told, but you're a first-time fund manager. Oh, my goodness gracious, if we had said that to men when they were first-time fund managers, we would have never gotten out of the gate. So it's a little bit fatiguing to continue to have that as a barrier. I just want to say one quick thing on just transition. Just transition has been used as an aspirational term that no one can say I'm against a just transition. But what does it really mean, and what does good look like? And so as part of the G7 report last year, we tried to explain what good looks like. And we say you need 3 elements. You need to demonstrate a net positive climate contribution. You need to advance socioeconomic equity and distribution in the transaction, and you need to engage with community voice. And it's that third element that will hold us all accountable, whether our capital is really making a difference or not. It's not easy to do, it's not formulaic, but we all know how to engage. Look at this event we're at today. We know how to engage, but we're not always engaging with communities who are most affected by the changes in the economy, and that's what we need to do more of.
Thank you. Olivier, I feel like you have a response to that as well, or you've been thinking about gaps in the ecosystem.
I don't know if it's a response, because I would support very much what Laurie has explained. But just talking about the gaps and the funding gaps, they are massive. If you look at the latest IPCC report, we are trending for a 3-degree increase by 2100 at the speed at which we are investing today. So the gap is really about speed and effectiveness of investment. The transition plan, if you take the figures of the International Energy Agency, it's $6 trillion that we must invest from here to 2030. We are a bit below 1 trillion today, and we should be on the plan at 5 trillion in a year or two. So you can see that we have a massive gap to fill in the next 2 years. And from that perspective, and you can see it, I mean, if you look again at the plan of the International Agency, we should have by 2030 60% of electric car industry. And if you look at the reality, I mean, I don't have the exact number, but we're probably way below 10% today. If you same for what we call the retrofitting of buildings. We should have by 2040, 50% of the buildings which are retrofitted to save energy. Today, we have a massive gap there, and we can see that it's going very slowly. So what I think is very important here is accelerate the investment, and you do that by innovation specifically. And I can see, and here, when you come here, it's fantastic, because you see there is about 250 corporates or companies coming with new ideas, new way to invest. And just to quote one I was discussing with today, Accenta, they are coming with this way to retrofit buildings through innovation energy. They are pumping the excess of energy into the soil, and they are reusing it later when you get to winter. And they are claiming that the investment, the return on investment, as we say in finance, is less than a year. So these kind of new technology are able to effectively accelerate the transition. It's going to be critical, and that's also one of the view of our association, GreenRWA, which is to say technology is a big part of the solution for the energy transition.
Thank you.
Yeah, maybe I could add the gaps are also in some asset classes that are a bit far away from sustainable investment. So, but they are advancing. I would take an example of private debt. So loans that are provided by either banks or funds to finance a transaction or to finance a company. Well, a few years ago, they had nothing to say on sustainable investment, zero. Now they created what is called ESG loans or sustainability-linked loans. So the interest rate of your loan goes down if you achieve some ESG targets, which is a great idea. But the main challenge is that when you look at these loans, well, the interest rate goes down only by 5 basis points. So believe me, it's very minimal, not very motivating. The targets are set by you don't know who and are not really related to the business of the company. And third, they are always achieved after year one. So it's not really used in the right way. So I believe that, yeah, they are moving in a good direction, but you need to push them a bit further.
Yeah, I think that's a great example. The tool makes sense, but how it's being applied is limited. I just wanted to double down. I think you make such a good point, Olivier, about the built environment. I mean, I think we really need to look at the built environment. We see a lot of investors putting money into infrastructure, but that's again where you can combine not just a climate consideration, but a social consideration. You look at mass transit, particularly in big cities. We're so far behind with livable and sustainable communities and cities in our SDGs, and we look at urbanization across the globe, and we really have to look much more forcefully. I'm all for technology and technological innovations, and it's so stimulating to be here, but new technology and apps are not going to ultimately address the built environment, and we need them both. And the last thing I would say is this is a really interesting and quite controversial trend. Some investors are saying we actually have to invest in the dirty stuff. And out of the Asian Development Bank at COP26, they announced that they were going to form a fund to buy fossil fuel facilities and then accelerate the transition. Because by investors just saying we're not going to invest, somebody owns this stuff. And if responsible investors are not going to lead it to an early decommissioning, then we're really not going to get to where we need to go. I just wanted to share that. I thought it was quite a bold move from the Asian Development Bank.
We're seeing a bit of that in the United States as well with coal-fired power plants and transitioning them. That's incredibly exciting. We have a minute left, so I'll just pose it out there. We've heard words of like tens of trillions of dollars that are needed in order to get to this, address some of our goals. Well, how can this community work together? How can investors better support each other? And I'll pose that to anyone.
Yeah, I can take the first one in about 20 seconds because I leave room for you, leave time for you. Maybe we need to move up sustainability, in the hierarchy of the investors or in the asset management firm. So that's what we do. We are strategy consultants doing ESG, not the reverse. So our interlocutors are C-levels at asset management firms, and believe me, they start to understand that sustainability is for real, and you can, make a good, profitable investment strategy based on sustainability and SDGs. So, having the right interlocutor in the room and making, a shift of mindset is key.
So I agree with that. Lead, share, allocate. So leadership is sorely lacking, especially in big institutional capital. There's a lot of rhetoric out there. There's a lot of expressions and acknowledgement, but we've got to lead. Share deal flow. Not everybody has to dominate a single transaction. We need all of that capital. Open up the table once you have led and allocate. Dial up your allocations for the things that you say you care about.
Yeah, and just to finish with that, I mean, on the banking side, what we're trying to do in our association with our members, and we are working between US and Europe to try to get banks, commercial banks and central banks around the table to find the right way to look at the risk engine question on climate risk. And it's very important, these kind of institutions, they work as a group, and there is always a balance in the discussion between central banks, commercial banks, and they need to converge to a common and commonly agreed principles on that matter.
Amazing. And with that, we'll close this panel out. Olivier, Laurie, and Emmanuel, thank you so much for lending your time and your hearts to this community, and enjoy the rest of ChangeNow. Cheers all.
Thank you very much.
I think you... Cecily, up to the stage. Round of applause for Cecily Cabanas. Cecily, I'm gonna have to get some water. These lights are pretty warm up here.